Hello to everyone and welcome to a new Energy Capital interview. Today, I'm very happy since I'll be talking with Hillary Holmes, partner in Gibson Dunn and Crutcher LLP and co-chair of the firm's Capital Markets Practice Group and also a member of the firm's Energy and ESG practice groups. Hillary, many thanks for joining us in this conversation. How are you?
I'm good. I'm glad to be here, Anna. Thank you.
Thank you very much, Hillary. Hillary will talk with us about various topics, but mainly about how preferred equity can help energy companies while looking for financial access and the role of environmental, social, and governance standards in capital raising. So without further introduction, I'll start with our questions. Considering the pretty uncertain times the energy industry has lived since last year, what role has preferred equity played in helping energy companies when looking for financial access? And in this sense, what do you think, Hillary, is the future of preferred equity in the energy industry?
Well, Anna, I think that the depression in the value of common equity in the energy industry has driven more companies to leverage preferred equity as a way to raise capital. Preferred equity provides an option to match the energy company's need for development capital to the investor's demand for predictable returns. It's a very flexible product, which makes it quite attractive. It can be structured like debt and have a maturity, provide for cash interest payments, have a no-call period and mandatory redemption under certain circumstances. And in that way, it looks very much like issuing a debt instrument, but under the guise of equity, which might be more palatable under the capital structure and the debt documents that the company might already have. But it can also be structured more like equity, but with a preference in the case of a liquidation of the company, which, as we all know from the last year, is a possibility for some issuers. So it can also be structured like equity to avoid issues under the company's existing debt documents and an adverse impact on the company's credit ratings. In this way, the preferred equity might be perpetual. It could allow for the interest to be paid in kind, not in cash, or it could even provide for a system where it has a liquidation preference that simply increases over time, similar to an interest rate. But in all cases, preferred equity will have restrictive covenants that protect the investor more so than if they just bought common equity, which makes it a more attractive investment for certain investors. They may have vetoes on senior equity issuances, incurrence of certain debt, distributions of cash, and of course, major transactions like a sale of the company or a bankruptcy. And when you talk about the future, I think we need to look to the past. Historically, there were many midstream companies that issued preferred equity in registered offerings to a broad retail base of investors. But this was really when the equity markets, the public equity markets, were more open to energy companies. More recently, preferred equity is issued only to select institutions on a private basis. And in the future, I think we will continue to see preferred equity used as a really valuable capital raising tool, particularly in my view, as what I'm seeing right at this moment is to finance specific projects. So the use of proceeds from the issuance of the preferred equity and the investors loaning, in all purposes, the money to the company is tied to a specific investment that is expected to generate returns in the future. And we've seen some of these instruments have restrictive covenants tied to the performance of the project. But however preferred equity evolves over time in terms of the specific negotiated terms of the product, it's going to continue to be a really useful capital raising tool in the energy industry.
Hillary, from what you see happening in the sector, what is the role of ESG in capital raising for the energy industry? And what do you see for the future?
So Anna, this is one of my favorite topics because ESG is absolutely critical to capital raising in the energy industry, particularly as the months, not even years, go by. 1 out of every $3 under professional management is tagged for sustainable related investments. And many investors are boycotting basically companies that don't have ESG friendly initiatives. And even beyond the general investor sentiment favoring companies that demonstrate a commitment to ESG, the energy industry is under particular pressure. So this is particularly important because we are at an intersection where there's an increased demand for ESG commitment and fewer dollars of capital flowing into the energy industry. So much capital is tagged for ESG-friendly investments, and so many investors are refusing to invest in companies that do not have ESG commitments, that ESG is playing a critical role in capital raising for the energy industry. We have a real opportunity to access an increasing amount of capital by embracing ESG initiatives. And not only can we access more capital, but we may be able to access cheaper capital. A great example of this is the sustainability-linked debt market. There's data that demonstrates that green bonds and sustainability-linked bonds price at a lower interest rate than regular way bonds. And just to pause there for one moment, green bonds, sustainability-linked bonds, there are also blue transition bonds and social bonds and others that fit within a framework that's defined by the International Capital Market Association. But they're all tied to sustainability-linked initiatives or socially friendly initiatives. Most of them look like a regular bond, like you've been issuing for decades, but the use of proceeds is tagged to a certain purpose that fits within a green bond framework or a social bond framework. A sustainability-linked bond's a little different in that the terms of the bond is actually tied to a specific sustainability performance target that the company sets. So the company may have a target like, we intend to reduce our greenhouse gas emissions by 10%, 2019 versus 2025. And if the company in 2025 has indeed reduced its greenhouse gas emissions by 10% as compared to 2019, then the interest rate on the bond will decrease by a certain percentage point. Or if they have not met the target, the interest rate will increase by a certain number of basis points. So there may be other covenants that become more restrictive if you don't meet the target as well. But the point being, it's a way to actually put your commitment to sustainability or social initiatives to really put your money where your mouth is, to make a real commitment to meet those targets. And the way this ties into cheaper capital is that basically I could tell you, an energy company executive, that you could issue debt at 50 to 100 basis points less simply by implementing a sustainability strategy like I just discussed, or leveraging one you already have implemented. A great example of this is one of the first sustainability-linked bonds in the oil and gas industry was oversubscribed by many times, which reduced the interest rate on the bond by a meaningful number of basis points. So this is a way, this is just easy money waiting out there for the energy industry to access. And because there's so much supply of this money. So the reason this results in cheaper capital is because there is great demand for sustainability friendly investments and not as much supply as there is demand. So if you can be one of the first energy companies out there offering a sustainability friendly product, like one of these debt products I just described, then your cost of debt capital may be cheaper. And, just generally speaking, in the future, energy companies that do not leverage ESG or write it off as unimportant or a passing fad are going to lose access to a growing pool of capital. And that may be critical in the years to come.
In this sense, Hillary, what differences do you see across the different energy industries, upstream, midstream, downstream, and power, and types of companies when applying for an ESG investment?
No one size fits all when it comes to an ESG strategy, and no one size fits all with respect to ESG, the acronym. So let me break that down a little bit. When no one size fits all for the different subsectors and different sizes of companies, is that you have to remember that different subsectors and different sizes of companies are under different pressures. So an ESG strategy should always serve as a complement to the basic strategy for the company to be profitable. and make a positive contribution to the larger economy and society in which it sits. Now, that can be defined different ways for different companies. Large global multinational oil and gas companies will have different resources, different priorities, and different pressures than a small, let's call micro-cap single basin oil and gas producer in domestic United States. So we cannot paint with too broad a brush these ESG initiatives. They need to be tailored to the particular company and their particular strategy. They may have different access to capital to execute on sustainability initiatives, for example, or they may have different pressures in terms of what investors are focused on with respect to their ESG initiatives. They may also, depending on the subsector, have different opportunities. So some power companies have taken, enormous steps that require massive capital to move from coal to natural gas. Some small oil and gas producers have taken sort of smaller steps, but meaningful ones, to reduce their emissions. Some services companies have found ways to leverage the services they were already offered as a environmentally friendly way to help the oil and gas industry be more sustainable. And the investor pressures also vary. Midstream typically under less scrutiny than upstream. Multinational global company typically more of a target than the small single basin oil and gas producer I mentioned before. So it's important that you not paint the entire industry with one ESG brush, but instead look at each individual participant and how they are responding to their opportunities and their challenges. The second thing I'd say is that I always tell clients to break down the ESG acronym. So what are you doing with respect to the E, the environmental? What are you doing with respect to the S, the social? And what are you doing with respect to the G, the governance? And there are samples within each that I bet any company I talk to can find quickly that are no cost and that already exist. They just need to be packaged and communicated to the public as such. And then leveraged, like through the access to capital point I made earlier. In telling people about what you're doing with respect to the E, the S, or the G, of course, it's always very important to manage liability. And that would be something that's not a difference among any subsector or size of company. So it's important for companies not to get too swept up in the excitement about ESG initiatives and make broad, sweeping statements about their philosophy or their intent or quantitative targets or other initiatives without the proper backup and strategic planning and review at the board level and then controls that are put in place, particularly with respect to aspirational statements, to ensure that the company is working towards achieving those goals. And then the last thing I'll say is that you may see fewer differences, at least with respect to disclosure, as regulations are adopted over the next couple of years. Right now, you putting one company's sustainability report next to another, or one company's statement about the diversity of their workforce or their leadership next to another it's not entirely apples to oranges, but it's certainly a red apple to a green apple. Just nothing looks exactly the same. But we can expect to see some standardized disclosure requirements over the next few years. So for example, in the US, the SEC's recently announced agenda indicates we can expect requirements for standardized disclosure about climate change risk and diversity in public companies. And also there's legislation in the US Congress even that would require mandatory disclosures regarding certain ESG metrics. Now, unlikely to become law, but definitely a sign of the times. It's unclear at this stage how all of that will play out exactly, but some type of standardized and prescriptive disclosure can reasonably be expected.
Hillary, addressing a crucial ESG component, and of course from your experience as a female professional in the energy sector, we would like to ask you, what do you think about what companies and energy-related organizations are doing to increase women's and minorities' participation in this sector, in the energy sector?
As we all know, studies from McKinsey and others reaffirm there's a strong business case for both gender diversity and ethnic and cultural diversity in corporate leadership. And they show that the most diverse companies are now more likely than ever to outperform their less diverse peers on profitability. So the question you're asking, Anna, is not one of altruism or doing the right thing. It's also a question of what's good for business. And I think energy companies recognize this, and most have proactively taken steps to increase diversity in their leadership and workforce. And while we've seen great advances in this area, there is much more work to be done. Historically, energy sector boards of directors, for example, have been the least diverse of any industry globally. And because of the historical lack of diversity at the board level and the management level, we need to put in some extra effort to make up some of that time we lost. And investors are not waiting around, and smart boards of directors recognize this. So, for example, institutional investors have become more and more vocal in their calls for public company boards of directors to become more diverse, both with respect to gender and race and ethnicity. The two largest advisory firms in the US, ISS and Glass Lewis, have enhanced their policies relating to board diversity, which will result in increased pressure for diversity on boards of energy companies that are in the Russell 3000 even, and the S&P 500. And one other important commentary I'll make is that the energy industry is facing new challenges and entering a new era. In order to successfully navigate this, we need intelligent, forward-thinking leadership, like we've always had in the energy industry. We are an innovative, resourceful industry. That is why we have succeeded where others would have failed. But in order to move forward, we need perspectives from both experienced veterans and fresh viewpoints and learnings from other experiences and industries. And I think that more diversity could help boards and management teams address the new initiatives and risks we face, because they bring different perspectives on how to interpret and tackle risk and leverage challenges for success. So we need all hands on deck for this new era.
Exactly. It is an opportunity, Hillary. So finally, could you share with us what Gibson Dunn is doing to further advance ESG efforts in the industry?
Certainly. Gibson Dunn is a thought leader in ESG matters and has a leading energy transactional and litigation practice globally. Gibson Dunn's ESG practice aims to provide holistic and sophisticated advice to our clients on their corporate responsibility and ESG risks and opportunities. As we've discussed, our clients in the energy industry are facing increasing calls from stakeholders and regulators, as well as within their own organizations, like from young workforce, to proactively address ESG across their business footprint. So in practical terms, this means our clients are grappling with a complex web of developments across jurisdictions, as well as growing industry guidance and regulatory scrutiny, and management of legal, reputational, and litigation risk. So we help our clients navigate all of this by leveraging a global network of lawyers in litigation, corporate governance, corporate transactions, capital markets, compensation, information security, human rights, and of course, energy. As another example of a way we're bringing thought leaders together even outside of our clients, Gibson Dunn is proud to be an architect and founding member of the ESG Council of Ally Energy, which is dedicated to diversity and inclusion in the energy industry. And our goal in setting up the council was to lead the energy industry in addressing ESG issues by bringing together leaders from every corner of the energy sector. The ESG Council members are united in their commitment to drive innovative actions that will help tackle some of the most pressing issues of our time, including sustainability, diversity, human capital, good governance, equity, and inclusion. And we at Gibson Dunn believe that we develop and accelerate solutions by bringing people together. We also believe knowledge is power. And we designed the ESG Council to help participants in the energy industry share knowledge and share their power. And then finally, as we all know, the energy industry is filled with smart, innovative people who are adaptive and collaborative. And we emulate this approach when we're counseling our clients on ESG issues in the energy industry.
That's great, Hillary. Many thanks for sharing these insights and information with us regarding this very important transformations that are happening in the energy industry, and that companies must be prepared and organizations must be prepared for them. So I don't know, Hillary, would you like to share some final thoughts with our audience in this regard?
Well, I agree with you. This is an opportunity for our industry. This is one of the moments pre-shale revolution, sort of seminal moments in the energy industry where we have transformed. The energy industry, I think, is getting better at sharing information across the subsectors and broadening beyond a segregation between oil and gas or power or renewable, and realizing that we need all of the innovative, intelligent leaders of all of those sectors to come together. And I think that if we were to visit a year from now, we would find that the sector has really moved forward and leveraged some of these, what some view as ESG challenges, and turn them into successes and opportunities.